Hello, everyone. My name is Marika Brewitz, and I represent the PRI, or Principles for Responsible Investment. Thank you so much for all the organizers for this opportunity to speak and share some insight into responsible investment and also what it means to be a responsible investor today. We're very aware of the PRI that responsible investment is a very fast-moving field with a lot of new changes happening all the time. So what are the principles and why is this relevant for you? So it is essentially the world's largest global investor forum and network for responsible investors. We now have over 5,300 members, including asset owners, investment managers, and service providers. We were convened in 2006 by the then UN Secretary General, Kofi Annan, and he got in touch with kind of 40 of the kind of largest investors, and they became our founding signatories. It was our founding signatories who agreed on the principles that you see before you on the screen. And they came up with these kind of principles when asked, what principles should responsible investors follow in order to achieve a kind of sustainable global financial system. So in essence, the PRI is really for and by investors, and we're therefore in a very good position to draw some kind of themes and highlight some kind of specific processes when it comes to responsible investment practices. As will become apparent by now, the PRI's focus is on investors and not corporates. However, some of the things that will be mentioned during this presentation will also be relevant to a kind of wide variety of stakeholders. So if you just move to, what is responsible investment, the PRI has kind of thankfully provided a bit of a definition. And in our way, responsible investment kind of is a practice that involves considering environmental, social, and governance issues, when making investment decisions, as well as when influencing companies or assets. So this is what we would call stewardship or active ownership. And it really kind of complements the kind of traditional financial analysis and portfolio construction techniques. However, it also kind of includes a commitment to transparency. And this is something that we've seen being picked up by regulators across the globe. So in the European Union, we have the taxonomy and the SFDR that really kind of focusing on this transparency and disclosure question. We also have the ISSB, for example. The other kind of component of a responsible investor would be kind of a commitment to constructive engagement with policy and regulators. So as you can see, ESG covers these kind of main three brackets, but they obviously in a way encompass everything that is going on in the world. And increasingly we're seeing the need to take a more integrated approach when it comes to ESG. So I included this one just to kind of bit of a focus on biodiversity. So this is a theme that we've seen a lot of interest in across our entire kind of investor base. And this is the kind of after the agreement or adoption of the coming Montreal Global Biodiversity Framework last year in December in Montreal, investment activity has really kind of ticked up. So I'm going to take this example and use the kind of yew tree example. So the yew tree that you see before you is the oldest tree in Turkey, and it's even the kind of one of the oldest yew trees in the world. It can be found in the Zonguldak region, and I apologize for my Turkish pronunciation. But I find yew trees to be very fascinating. They're very poisonous and they're very long-lived. And they're also found to have these kind of regenerative properties. So it can regenerate itself, and hence a reason why it can grow so old. Remarkably, yew trees have also given rise to two of the most important chemotherapy drugs in the world. They're now made synthetically, which is really good, but Taxotere and Taxol, so they come from the bark and the pine needles of the yew tree, have saved thousands, if not millions, of people's lives. This is only one example of how we rely on the natural world when it comes to pharmaceuticals, and around 80% of the world's kind of registered medicines come from the natural world or are dependent or inspired on it. So the erosion of biodiversity that we're seeing or experiencing is likely to result in fewer drug discoveries. And as we know, this is one of the kind of main drivers of profitability when it comes to pharmaceutical companies. And research indicates that we are losing one important new drug every 2 years due to biodiversity loss. So this affects the whole kind of pharmaceutical supply chain and also the investors who are invested in pharmaceutical industries. So if you're a diversified investor with holding in pharmaceuticals, the profitability of these holdings could be directly impacted by the biodiversity losses caused by the other sectors that you invest in. So this is what we would call the universal owner principle, and the reason why it is increasingly becoming really important that you consider ESG in your investment activities and in your portfolios. So really to kind of talk about the internal drivers of ESG. Of course, there are also external drivers such as regulation, but who focus on the internal drivers for a moment. So thousands of investors worldwide have incorporated ESG practices, metrics, and analyses as a way of kind of reducing risk or learning more about sustainability opportunities and so forth. And there are, of course, many reasons why institutional investors and retail investors decide to invest responsibly. So the list that you see before you is not conclusive at all, but it's really to give you a flavor or an example of what drives the kind of responsible investment processes within PRI's signatory base. So the first one is really alignment with brand values. So a lot of investors decide to avoid companies that are involved in business activities that are not aligned or actually outright conflict with their own brand values. This, of course, this is an ethical consideration and will vary from investor to investor. The other driver that we have noticed is just the kind of enhancing financial returns. So they invest sustainably because they believe that the companies that they invest in are more well positioned for the kind of long-term ESG trends. So this could be kind of investing in companies that have attractive revenue growth from products and services that address global challenges, or companies that are more efficient in managing their costs and capex requirements given kind of environmental constraints and issues that we see. Another kind of advantage is that ESG analysis takes into account intangible factors very well. And there's this kind of bargaining consensus that intangible factors kind of outweigh the tangible factors when you look at corporate value. Also, I mean, ESG analysis kind of better enables investors to identify the companies that are better managed by looking at the kind of additional information that you can get by applying an ESG lens to corporate analysis. Then, of course, we can't forget risk management, which is the kind of traditional pathway into ESG investment. And that is really considering the ESG considerations that could have a material impact on the financial performance of the companies if not managed properly. So ESG kind of allows for the pricing of externalities, such as kind of shadow carbon pricing. And that really starts from the premise that many of the kind of costs of businesses are not actually kind of accounted or priced in when it comes to kind of goods and services. So these costs are borne by society, governments, or ecosystems. However, there is this kind of tendency that we've seen that these externalities may actually be priced at one point. So by including what we call the kind of shadow carbon pricing, an investor can be one step ahead of the curve and really be prepared for when these externalities are starting to get priced properly. Of course, as well, ESG analysis can be used to really manage more these kind of idiosyncratic risks, such as corporate scandals or an environmental scandal that can have a really high impact on the value of an entity. And lastly, let's not forget as well, we are seeing now a trend after the latest COPs to investors really want to maximize the positive outcomes or investments of their investment activities. So that is another reason why investors may consider taking a kind of responsible investment approach. So now really to talk a bit about policy. So just as every investor is unique, there is no such kind of thing as one type of responsible investor or no correct approach to conducting responsible investment. It really depends on a variety of factors. So your own investment motivations, the investment motivations and your clients and what they are interested in, regulatory demands, and how an organization interprets and implements kind of their fiduciary duties. And again, it really depends on what you invest in. So asset class, if you are an equity investor, you may focus on the impact of ESG on corporate performance. And if you're a fixed income investor, you might use ESG analysis to kind of manage downside risk. However, there are some kind of unifying factors that kind of goes back to accountability and really kind of this transparency. And these kind of unifying factors is most, if not all, responsible investors have a responsible investment policy. This kind of goes back to if you have a policy that is signed at the highest level, you can be held accountable for its implementation. Civil society can make sure that you actually fulfill what you set out in your policy. So 99% of all PRI signatories have a responsible investment policy. Of those with the policy, 73% include guidelines on environmental factors, 68% include guidelines on social factors, and 69% include guidelines on governance factors. In addition, 76% also include kind of approaches to stewardship. And also to mention, 68% of PRI signatories are also supporting the Paris Agreement. So this slide here really kind of shows some examples of potential components when it comes to a responsible investment policy. It can be integrated or standalone, but it's normal that it includes a purpose, the scope, the responsibilities, how it will be implemented, and as well as how do you as an organization intend to report on your progress as set out in the purpose and objectives of the responsible investment policy. So really, if we go back to the principles, I wanted to, again, take this opportunity to highlight a few practical things that responsible investors could do. I mean, this is an emphasis on could. There's nothing that you absolutely have to do, but things that a responsible investor could do in order to be aligned with the principles. And I will go through these rather quickly, but if you are interested in reading it, please let me know or reach out to me and I will send you the slides after this presentation. So if we go really to principle 1, so the incorporation of ESG issues, you can address ESG issues in your policy statements. You can also support the kind of development of internal ESG related tools, metrics and analysis, and assess the capabilities of both external and internal investment managers when it comes to their ability to incorporate ESG issues, and also to ask kind of third party and service providers to properly factor in and integrate ESG factors. So if we go to the second principle, which is about active owners and the incorporation of ESG. And that is really to develop and disclose your stewardship or active ownership policy. And then if you are invested in listed equity, to exercise your voting rights and monitor compliance if you use proxy voters when it comes to your voting policy, as well as kind of sharing your shareholder resolutions and engaging with companies on ESG issues. Again, principle 3, and this is important for corporates, but we are approaching this landscape where we need standardized disclosure. So engaging with your corporates and asking for standardized reporting, such as the kind of global reporting initiatives, TCFD, and the upcoming TNFD, which will focus on nature-related financial disclosure. It's also asking for ESG to be properly integrated within annual financial reports and asking kind of information for companies to really increase disclosure and make it part of, or like increasing the investable universe, even when it comes to responsible investment. So again, principle 4, and this is really promoting acceptance and implementation of the principles in your market and where you are operating. Comes back to a lot of the kind of importance of clearly communicating expectations, both to service providers as well as corporates, and if you're a pension fund or an asset owner, to your investment managers. So having that kind of clear communication lines. So now we have the fifth principle, and that is really emphasizing the importance of working together with other like-minded peers achieving your goals. One investor has a lot of influence in the market. If you take that and you multiply it by 10, real change can happen very, very quickly. And this is one of the really promising things we've seen from the latest COPs, both in Egypt and in Glasgow, that the real economy is moving very, very quickly, a lot quicker than governments in some instances. And this is really due to the compounded effect of collaborative engagement and working together. Then, very importantly, the sixth principle has to do with reporting. So reporting on our activities and progress. And really that is to disclose how ESG is integrated within your investment practices. If we go back to biodiversity, this is something that is very promising. And since this is a very new area for investors, we have already seen a lot of information sharing about how certain investors go on when it comes to integrating biodiversity considerations into their portfolio, from kind of what data they use, how they source the data, how they engage with both corporates and investment managers on biodiversity. So we've seen a lot more information sharing, which is very, very positive. But again, really comes back to that kind of accountability that I was talking about earlier, and the importance of sharing both kind of data as well as disclosure and how you are integrating ESG. So this slide is really to kind of give an overview what ESG integration could look like. So this is slightly different from just the traditional way of a kind of traditional investment process. Again, this is only an example. It will look very different from investor to investor. But first, if you're a responsible investor and you look at the investable universe, the investable universe must kind of reflect ESG. It should kind of, or could include corporates and entities that provide ESG disclosure, corporate responsibility or sustainability reporting, or where information on ESG is available from third parties. So that is the kind of basis. You need to have some sort of information that pertains to ESG. And then when we have the financial screening, you can refine the kind of traditional standard process of financial screening by also using ESG metrics, which can identify when corporates perform below their peers in a certain sector. And you can also kind of correlate ESG performance trends against other performance indicators. Normally, this would take form of the kind of proprietary ESG benchmark, and it could be used to assess ESG across a range of measures. Then if we kind of move one step up to the fundamental analysis, it now kind of is complemented with an ESG analysis as well. So that really would include the material or identification of the material factors that a company may face. It could be a global kind of mega trend or an economic or industry kind of specific concern or issue. And then this ESG analysis feeds into the financial analysis, and it gives you a kind of greater understanding of the company and the challenges that it faces. Again, these findings can be directly quantified in the financial projections or indirectly assessed by kind of changing a company's projected risk level and its discount rate. Again, if we kind of move one step up this little pyramid and we get to portfolio optimization, this is where the ESG benchmark can really help in the portfolio modeling, and especially in relation to kind of long-term performance targets. And you can also optimize it by kind of considering intensity metrics, such as carbon intensity, to see how your portfolio is performing. When we then get to portfolio monitoring, you can as well monitor for substantial ESG risks to make sure that you are prepared to take action if such a risk would actually materialize. And lastly, we have active ownership. So really engaging with the management of the selected portfolio companies or engaging as an active bondholder. And it's really ensuring that you are in charge of your portfolio. I'm approaching the end of my presentation here, and this is really to talk about the latest trends that we're seeing at the PRI. So the first one is kind of what I've already mentioned, disclosure accountability. We have the ISSB, we have the TCFD, we have the TNFD, and in the European Union, the SFDR. This is again to really address the issue of greenwashing and help make sure that we don't see kind of widespread misuse. Again, climate continues to be a key issue for both our asset owners and investment managers. There's also more of a focus on diversity, equity, and inclusion, and again, the role of engagement and active ownership. And lastly, the importance of taking an integrated approach that considers E and the S and the G together and making sure that we are moving forward at all kind of times. Thank you very much. That is the end of my presentation.